Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase. Now on Mondays we usually focus on how data and events are likely to guide the week ahead in markets, but today I wanted to first start with a brief review of Friday. Equities in the US had a particularly volatile session, so it's worth understanding the details and implications of that, so we set ourselves on a firm foundation for the week ahead. Now first the facts. On Friday, the S&P 500 fell 2.8% while the Nasdaq fell 2.6%. Equity weakness was largely limited to the US. The Eurostoxx did fall as well, but not by as much, and Asian markets were largely not impacted. The volatility was also largely limited to equity markets. Now, in our view, one key driver of the weakness was Fed Chair Powell's comments at IMF meetings. Powell said that, first, a 50 basis point rate hike was on the table for the next policy meeting, that investors were reacting appropriately by anticipating several 50 basis point rate hikes this cycle, and that the Fed's goal was to address the inflation challenge, quote, without a slowdown that amounts to a recession, while noting that doing so would be very challenging. Now, this last point in particular is something we found interesting as it feeds into a broader discussion on whether the Fed will indeed be able to tighten policy and lower inflation, but without pushing the US economy into a recession. Now, as we've said before, this is expected to be a challenge for Fed policy once policy rates move to outright levels, though this means that this is likely a debate only for next year, as interest rates currently still have quite some distance to go before we get to that point. Now, rising inflation expectations and ECB policymaker comments likely added further pressure to markets on Friday. In the US, 10-year inflation expectations rose above 3%. And while there's a lot of focus on likely Fed policy, of course, a comment by European Central Bank Vice President Kindos that a rate hike was possible after July also stood out, though President Lagarde, of course, remained far more ambivalent. Now, what do we make of all of this? It's clear that shifting Fed rate expectations continue to have an outsized impact on markets. However, short of another energy price shock or supply chain disruption surprise, a fairly aggressive rate hiking cycle does seem priced in markets. And this suggests focusing on three areas to guide markets in terms of future catalysts from here is key to focus on, particularly so in the coming week. First, of course, is earnings, particularly in the US. So far, the picture has been positive, with about 77% of company earnings surprising positively versus the long-term average of 66%. However, about 180 companies are due to report this week, including some with the largest market capitalizations, and we would keep a close watch in particular on the earnings surprise ratio, as well as indications of how profit margins are evolving. Second is major macro data. In the US, we'll be closely watching consumer confidence and new home sales data, given these are likely to be key determinants of where economic growth ends up later this year. However, China's unofficial Caixin PMI is also likely to be key given the significant growth concerns in China. The Bank of Japan also meets to set policy later this week. So while no changes is expected, the focus is very much likely to be on any comments signaling how the BOJ views the recent sharp fall in the yen and whether any form of intervention is likely to be forthcoming. Europe, of course, also set to release CPI inflation data. Third, we'll be watching market technicals. Even after Friday's drop, S&P 500 technicals remain consistent with a range-bound outlook, with the next supports near 4,200 and then 4,100. For the 10-year US Treasury yield, which remains a key channel, but through which shifting Fed and inflation expectations feed into market, 3% and then 3.26% remain key technical resistance levels. So quite a lot to watch this week, but we'll take a pause there. If you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy trading week ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.